Listen carefully to what I'm about to say. Don't skip this. Don't look at anything else on your screen. For the next few minutes, just focus on my voice, because one small money decision you're making right now could quietly cost you tens of thousands of dollars over the next 10 years, and most people don't even realize they're making it. Alex saves every extra dollar he earns because he wants security. He likes seeing his bank balance grow steadily, knowing that no matter what happens, he has a cushion. Jordan does the opposite. He invests every extra dollar into the stock market because he believes that playing it safe is actually risky in the long run. To him, inflation is the real enemy, and if his money isn't growing, it's quietly losing value. They're both 30 years old, both earning $60,000 a year, and both starting with $15,000 already saved. Every month, they each have an extra $1,000 they can either save or invest. Same income, same starting point, same opportunity, but one decision begins to shape their entire financial future. At first glance, this seems like a simple math problem. Alex keeps his money in a high-yield savings account, earning about 4% annually, while Jordan invests in an S&P 500 index fund expecting around 10% returns. On paper, Jordan clearly wins. Over time, compounding at 10% grows wealth significantly faster than 4%. This is exactly what most financial advice online tells you. Invest early, invest consistently, and let compound interest do the heavy lifting. But there's a hidden assumption behind that advice that almost nobody talks about. It assumes that you behave perfectly. It assumes that you keep investing every single month no matter what's happening in the market. It assumes you don't panic when your portfolio drops. It assumes you don't pull your money out during a crash or try to time the market. It assumes you think long-term even when everything around you feels uncertain. In reality, most people don't behave like that. Real life is messy, emotional, and unpredictable, and that's where the difference between saving and investing becomes more than just numbers. 3 years in, everything looks fine on the surface. Alex has built his savings steadily. Between his initial $15,000 and his monthly contributions, he now has around $53,000 sitting safely in his account. There's been no stress, no volatility, and no surprises. Jordan, on the other hand, has about $60,000 invested. On paper, he's ahead, just like the math predicted. But his experience getting there has been completely different. At one point during those 3 years, the market dropped nearly 20%. Jordan watched thousands of dollars disappear from his portfolio in a matter of weeks. That's the moment people don't fully prepare for, not the gains, but the losses. When the market drops, it doesn't just test your strategy, it tests your emotions. Jordan tells himself to stay calm and trust the process, but it's not easy. Every headline is negative. News channels are talking about recessions, layoffs, and uncertainty. Friends and co-workers are pulling their money out, trying to wait until things feel safe again. And in moments like that, logic takes a back seat while fear takes over. This is where the real gap begins, not between saving and investing, but between theory and behavior. If Jordan stays disciplined, keeps investing his $1,000 every month, and ignores the noise, his strategy works exactly as planned. Over time, the market recovers, his portfolio grows, and he builds significantly more wealth than Alex. But if he hesitates even a little, his results start to change. If he skips a few months, pauses his investments during downturns, or pulls money out temporarily, his returns drop dramatically. And this isn't just a theory. The average investor doesn't actually earn 10% annually. In reality, most people earn closer to 5 to 6% because they make emotional decisions. They buy when things feel safe, which is usually when prices are high, and they sell when things feel scary, which is usually when prices are low. Alex doesn't face this problem. His money doesn't fluctuate. His account doesn't suddenly drop 20% overnight. There's no emotional roller coaster, no pressure to make decisions under stress. Every month, he adds $1,000, and every month his balance goes up. It's predictable, stable, and easy to stick with. And while his returns are lower, His consistency is nearly perfect, and consistency matters more than people think. By year 5, the difference starts to become more noticeable, but still not as extreme as most people expect. If Jordan has been perfectly consistent, he's ahead. His portfolio has grown faster than Alex's savings. But if Jordan made even a few emotional mistakes along the way, the gap shrinks quickly. Meanwhile, Alex continues doing the same thing he's always done: no changes, no stress, no second guessing. This highlights a deeper truth about money. Success isn't just about choosing the strategy with the highest return. It's about choosing the strategy you can follow consistently, 4 years without breaking. Now fast forward to year 10. If everything goes perfectly, Jordan could have around $200,000, while Alex might have around $150,000. That's a meaningful difference, but that outcome depends on Jordan being almost perfect for an entire decade. No panic, no interruptions, no emotional decisions. And that's where most people struggle, not because they chose the wrong strategy, but because they couldn't stick to the right one. Because life doesn't stay predictable. Unexpected expenses show up, job situations change, the market crashes at the worst possible time, emotions take over when you least expect it, and suddenly, the plan that looked perfect on paper becomes difficult to follow in real life. Alex's approach, while slower, is extremely resilient. It doesn't depend on timing. It doesn't require emotional control during market crashes. It doesn't rely on perfect discipline. It just requires consistency, and consistency is much easier when your plan doesn't feel like it's failing. But this doesn't mean Alex is right and Jordan is wrong. It means the real question isn't which strategy makes more money on paper. The real question is which strategy you will actually follow for the next 10 years without quitting. Because a perfect strategy that you abandon halfway through will always lose to an average strategy you stick with consistently. There's also another factor most people overlook: lifestyle inflation. As both Alex and Jordan grow in their careers, their income increases. Promotions, raises, side income, it all adds up. But so do expenses. It becomes easier to justify a nicer apartment, a better car, more travel, and more spending. If they're not careful, that extra $1,000 per month disappears without them even noticing. Jordan's strategy can protect him from this if he invests first before spending, but only if he stays disciplined. Alex's strategy gives him more flexibility, but it also creates more temptation because his money is easily accessible. So now this decision is no longer just about math or returns. It becomes a question of behavior, discipline, and self-awareness. If you know you can handle volatility, ignore market noise, and stay consistent no matter what, then investing early is incredibly powerful. But if you're someone who checks your account frequently, reacts emotionally, or struggles with consistency, then a slower, more stable approach might actually lead to better results over time. Because the biggest mistake people make isn't choosing saving over investing or investing over saving. It's overestimating their ability to stay disciplined. Everyone believes they'll stay calm during a market crash until it actually happens. Everyone believes they'll keep investing no matter what until uncertainty feels real. Everyone thinks they'll follow the plan perfectly until emotions get involved. And that's why the gap between Alex and Jordan is often much smaller than expected. Not because the math is wrong, but because human behavior changes the outcome. At the end of the day, both strategies can work, both can build wealth, both can lead to financial freedom, but only if you stick with them long enough for compounding to do its job. So the real takeaway isn't to blindly choose saving or investing, it's to build a system that works for you. Automate your decisions so you don't have to rely on willpower. Make consistency easier than quitting. And most importantly, be honest with yourself about your behavior, not just your goals. Because your financial future won't be decided by a spreadsheet or a return percentage. It will be decided by what you do every single month, even when it's uncomfortable, even when it feels uncertain, and even when you're tempted to stop. And in the end, the strategy that wins isn't the one that looks the smartest on paper. It's the one you actually follow all the way through. Disclaimer: this video is for educational purposes only and not financial advice. Always do your own research before making any financial decisions. Investing involves risk,